Since monetary policy tightened, bond yields have remained elevated. And taking the US investment grade universe as an example, the bulk of those bonds now yield over 4%. Pre-pandemic, most of those bonds were looking at yields above 2%. And similarly, if we look at US high yield, those bonds in particular are offering yields of above 6%, whereas rewind to 2019, and we were looking at yields of above 4% for most of those universe. What I think is particularly interesting in all of this isn't just the levels that we're talking about, it's the stability of those numbers since October 2022. To understand whether there still is opportunity for bond investors in corporate bonds, I'm delighted to be joined by David Roberts, a veteran 30-year global bond investor. And together we'll be discussing how, despite tight valuations, opportunities still exist for investors who are selective. However, investment success demands a fundamental approach to unearth quality and avoid those value traps. So David, lots of ways to cut the data here, but from a top-down perspective, where do valuations look?
Yeah, thanks, Nisha. As you say, I think it's notable that spreads, so the difference in yield between corporate bonds and government bonds, that spread has been very stable for several months now. As you say, the absolute level of spread does remain wide of averages over the last few years. So perhaps optically, certainly to those with a shorter investment horizon or maybe a shorter career history than me, can find reason for them looking like very good value. It is worth noting, though, that the extra return you get from investing in credit, so again, that spread, is actually much smaller as a proportion of your likely return than it was 4 or 5 years ago. And you mentioned this move from 2% to 4% on corporate bonds. It's a little bit higher than that. But most of that has come from a move in the underlying government bond market. So if we think about it, when government bond yields were 1%, you received about an extra 1% yield for owning quality corporate debt. So that doubled your yield. Whereas today, those same government bonds are now paying about 4%. The spread on corporate bonds hasn't changed much, so you get 5%. But put another way, rather than doubling your money, your yield anyway, buying corporate debt, today you're only getting about an extra fifth. So as you know, though, bond funds normally see the total return as a combination of yield and then the movement in capital. So we like to think capital gain, but also the possibility of capital loss. And our view is that those capital values will actually be much more stable in the next couple of years than they have been of late. So focusing on that yield as the source of the majority of your total return is very important. And if the proportion of that extra return payable from the corporate bond spread has actually fallen, then again, that's another reason that says it's quite difficult to say that valuations are cheap, Nisha.
Thanks, David. I mean, I think what I'm hearing from you is valuations are okay-ish, but not exceptional. Well, fundamentals and technicals are also essential inputs that you pay attention to as you think about the investment opportunity. As a veteran multi-sector investor, what are they telling you about the situation? And we're still talking about an economic slowdown. So what does the outlook look like for you?
Yeah, that's true, Nisha. So valuations are a starting point, but it's quite easy to find a market that looks expensive, but you can also find other reasons for buying it. And from our perspective, that's fundamentals or technicals. Likewise, a market might appear cheap, but there could be very good reason for that. And exactly as you say, so corporate bonds per se generically just don't look blindingly cheap. But if we think about it from a fundamental perspective, it's also true, I would say, that the market is discounting the possibility of a recession. Recession's just not in the price. And if you add in the fact that the cost of capital for many companies has also risen quite materially, then those are not reasons to be positive in the market. The flip side of that is inflation, perversely, can actually be very good for high quality bond issuers. Certainly if it's a short dose of inflation, it boosts earnings, and companies have the opportunity to distribute those earnings, but if they retain some of them, then that makes metrics such as the debt service ratio, the debt service coverage ratio fall, makes them stable, better, less volatile, less risky investment. So fundamentals a bit of a mixed picture. When we talk about technicals, we're not talking about charting and quantitative analysis. Rather, what we mean is looking at the interaction between technical drivers of performance for the bond market, such as supply versus demand, investor sentiment, and positioning. And all of those are actually quite mixed too. I would be honest, we're not that worried about companies having to refinance at higher coupons, cost of capital increasing. As I mentioned before, that is a drag, but we see it more as a drag in company performance rather than as a source of mass defaults. Finance directors do tend to be quite smart people, and many have taken advantage of the cheap debt over the past decade to term out their borrowings. So we're not worried about a mass wave of maturities of new money coming to the market that might tip the balance in favour of excess supply. But against that, we do know that a lot of investors are now up to certainly close to full weight on corporate debt, certainly compared with where they have been for many years. And that's logical as yields have increased. But that does then mean that supply-demand dynamic is actually fairly balanced. So if we run all that together, Nisha, so valuations don't look particularly cheap, and then fundamentals and technicals are quite mixed in all honesty. So it perhaps accounts in part for the market being a little bit dull in aggregate, and certainly there'd be no real reason to be either aggressively overweight or underweight corporate debt, in my view, at current levels.
Okay, so just I suppose picking up on your point around the rising cost of capital, that's now featuring into corporate margins because whilst we've seen solid earnings growth, stable cash flows, and pretty healthy interest coverage ratios over the last 15 years, the interest expense has exploded since policy has tightened. What does this mean for investors over the long term?
Yeah, that's a good way of looking at it. So I've talked a little bit in the past couple of minutes about genetic levels in markets, and we need to realise that not all parts of the bond market, not all sectors of the corporate bond market are the same. Economic uncertainty and the change of interest rate regime we've seen, so obviously aggressively tighter policy, means that there are definitely winners and losers. And I think that will be a theme for the next couple of years because we're really just starting to see that higher cost of capital kick in. And we'll see those winners and losers at geographic, at sector, and then certainly at individual company level. I guess, for example, an easy example, it's fairly obvious that BBB rated companies, so the ones that are kind of the higher geared, the higher levered companies for investment grade ratings, are more exposed to the monetary cycle than better rated, lower levered, AA rated ones. Again, we're kind of generalizing a little bit. So unless those BBB companies can offset that increased cost of capital, perhaps through expansion of earnings, they will become slightly higher risk, both in absolute terms and then also relative to AA rated companies. So there's perhaps an opportunity to play a ratings theme there as capital costs change. But the same is also true at sector level. And again, just a simple example, the US utilities are quite often in the news. And it might surprise many to realise that their average rating for the investment grade part of that market is actually in the single A category, above where US insurance company paper is rated generally BBB. So leverage is only one reason that explains rating sector difference, and we need to work out other factors and whether or not they mitigate those ratings differentials. But if they don't, then again, that starts to give you an opportunity to play one sector against another. Say, just with an absolute single factor, you would prefer utility versus insurance just simply based on ratings alone. But if we then break that down to the next level, so we just look at BBB rated companies, for example, there's a world of opportunity there. And again, just to use two examples that certainly be familiar to UK investors. Tesco supermarkets, they are senior, so that's kind of top of the waterfall corporate debt is BBB rated and actually quite lowly rated. And a question for us then would be, is that BBB rated Tesco senior paper better or worse risk value adjusted, of course, than similarly rated BBB Lloyds Bank subordinated debt? So a whole pile of concepts there: senior versus subordinated, food retailer versus banking, whole pile of different things even within a triple B category. I guess just to sum all that up, Nisha, that the point is that the bond universe is vast and it offers opportunity, geographic, sector, stock specific, and not least of all when we see a change of monetary policy regime.
Thanks, David. Great to kind of get deeper into the detail there. And I guess just to summarize our conversation today, valuations are tight, but actually the asset class still offers opportunity for active investors. And to identify winners and losers, a fundamental approach is key. Well, we hope you enjoyed today's episode. Thanks for joining us and have a great rest of the day.